So good. We'll get started. Today's topic is on understanding market mechanics. I call it, in the simplest way, is actually the fundamentals of the forex market. And in the approach, right, in terms of the analysis towards the FX market, generally we can say there are three types: the fundamental, the technical analysis portion, as well as the sentiment. Right. So today we're gonna have a combination of the fundamental aspect as well as a little bit on the sentiment aspect. That's where we'll put that together and say that that's actually the market mechanics, right? Of course, today as we go into the live market environment, we're gonna deal with charts, but the content that I prepared to cover for today focuses more towards the fundamental side of things. Okay, so today's objective to understand the building blocks of fundamental analysis. If today it's your first time, hearing what exactly fundamental analysis is, no worries, we're gonna cover that. Okay, you're gonna be appreciative by the end of today's session. Some of the catalysts that moves the market. Okay, sometimes you might be looking at the chart and wonder, right? How come suddenly the market moved a lot? Just like last week, right? Especially closer to the end of last week, we have the dollar strengthening quite significantly, right? So if you don't understand fundamental in a certain way, you might be wondering, like, how come, right? What causes the dollar to suddenly strengthen so much? Okay, we'll talk about it today. And of course, when you understand fundamental, you kind of had an idea of what moves the market. Okay, and one of the strength of fundamental is really to help you decide the big picture, right? So if today you're looking at swing trading, you're looking at longer term direction, fundamental does give you that. Okay, so those are the objectives for today. And of course, once we cover the content, we'll go on to the live market analysis portion to share with you some opportunities that you want to keep an eye on for the week. Now, as we talk about fundamental analysis, we have various terms that I tend to use it quite interchangeably. Whether I call it fundamental, I call it macro, I call it market mechanics. They're essentially the same category. Okay, so when we talk about this, there are generally three processes that you need to be familiar with to understand the fundamentals of the FX market and then translate that into practical application. Okay, so fundamental over here, if I break it down into big categories of things you need to take note of, the first one is the central bank. Then the second category, the component here, is economic indicators. And the last component is to make sense of those information. Okay, so you as a trader, as you approach the market and you want to understand the fundamentals, the market mechanics, you need to get a good understanding of this three component, right? You need to know what are central banks, what they do, what can they do, okay, what's their objective, and then you look into the economic indicators, which on a week-to-week basis, you're going to have a lot of those coming out in terms of data points, economic data, to tell you how the economy is performing, and that's going to impact the currency market as well, right? Case in point, last week, the dollar strengthened. Okay, and you as a trader is to make sense of that and of course look for opportunities to trade the market, right? Mandate over here is a very fanciful way of saying KPI. Okay, what's the objective, what's their target? Okay, so most of the developed central banks has two things in common. One is price stability. Now, what is price stability? It's essentially ensuring that prices of goods and services in the economy doesn't fluctuate too much. Okay, and the word that you probably hear a lot when we talk about price stability is inflation. Okay, so how does inflation impact the economy? Inflation means that prices of goods and services are rising, right? And if inflation rate is very high, prices are increasing very fast. Okay, and if inflation is negative, it means that prices are falling, the economy is not growing. Okay, so price stability is basically to ensure that inflation is not too high and not too low. Okay, so that's one of the key objectives that the bank needs to ensure. And most of the developed countries would have this fixed number as their target. Okay, and the target of their long-term inflation is 2% per annum, 2% per year. So if it's too high, they need to do something about it. If it's too low, they need to push it up to meet their target at 2%. Okay, so that's price stability, which is inflation rates target. And then the second one is more straightforward, right? That one is dealing with employment data. Basically, the bank needs to ensure that people needs to have jobs so that the economy can continue growing. Okay, so that's quite straightforward. Okay, so they want an unemployment rate to be as low as possible. They want inflation to be somewhere around 2%. Okay. Now, some countries, if let's say you're based in Singapore, right? Singapore banks would have, or MAS, right? Monetary Authority of Singapore, they would have an additional target or mandate, okay? And that is basically their exchange rate policy, which means MAS, Central Bank of Singapore, will need to ensure that the Singapore dollar maintains within a certain bandwidth in terms of their exchange rate policy, because Singapore is a country that's very reliant on imports, right? So they need to ensure that the imported goods does not become too expensive. They need to have certain bandwidth for their currencies. Okay. What does this mean to you and I? Basically, it means that, in short, okay, if the economy is too strong, is growing too fast, or inflation is too high, which is what we're experiencing right now, central banks need to step in to prevent hyperinflation. Now, hyperinflation basically means that prices of goods and services just keep going up, and it's kind of lost control of it. Okay, so for example, if you think about it, some countries have experienced that before. For example, Zimbabwe. Okay, you look at their currencies, a lot of zero behind. Indonesia, okay, if you look at their currencies, also a lot of zero behind. Usually, currencies with a lot of zero behind means that they have, at one point in time in history, kind of experienced hyperinflation. Okay, in other words, hyperinflation as prices of goods and services keeps going up, out of control, right? What it also means is that your value of your currency drops a lot, okay? So much so that it doesn't worth much anymore. And, to compensate that effect, you have a lot of zero behind of the currencies, okay? So it's not a good thing if the economy is too strong, okay, because of hyperinflation, so the bank needs to control it. The opposite of it, too weak, is also not good, right? Because that is where we're going to experience recession. People don't have jobs, there's no demand in the economy, then the country will also collapse, right? Because everything is not working. So both sides of extreme is not good, and the bank role is to ensure it maintains a healthy balance, right? So that's what it really means in a very simple version of it, okay? So once you understand, okay, the banks have certain objectives that they need to achieve, the next thing that you need to then know is how can they achieve it, right? What are the things that they can utilize to achieve price stability and full employment? So over here, there are generally three things that the central bank can do. One is, I think most of us are very familiar with it by now. If you're looking at what's happening at this current state, it's called interest rate, right? So the bank can actually increase interest rate or drop interest rate, and that would have an impact in the economy as well, right? So interest rate from an investor point of view is actually interest received, right? It's like the higher the interest, the better it is as an investor, because you're going to receive more interest. But from a consumer and business owner perspective, it's actually a cost, right? Because if interest rate is high, people who wants to borrow money would think twice. Business owner who wants to borrow money would think twice, right? They'll be thinking, oh, if the interest rate is so high, maybe it's not the best time to borrow money to expand the business, right? Maybe you want to wait for another time. So interest rate itself, from an investor perspective, the higher is the better. They love that. However, from an economic point of view, for individuals and businesses, they don't want it high, right? Because that is actually cost. All right. So that's the part on it. Okay. So that's on interest rate. Okay. And another tool that the central bank can do is what we call quantitative easing, in short, QE. or you might term it as monetary policy. QE, some of you might see it as printing money, right? Of course, it's not so simple as like just print and give you, right? It's not as simple, but you can really think of it from that angle, okay? And the whole idea is basically controlling the money supply, right? So the more money that the central bank releases to the economy, then generally what will happen is people will have more money to spend, okay? And that would then have an impact in the economy, right? If everyone starts spending, demand is there, it pushes prices up, there's activity within the economy, right? The opposite is true. So if the central bank decides to print less, there's less money supply in the economy, people would be more cautious and they won't anyhow spend, right? So that would also have a direct impact in terms of like whether the economy is good or bad and what the bank wants to do to kind of impact that. Okay, so that's QE, or you can call it monetary policy. Okay, the last one here that not many people actually know about or even factor that in is what I call language. Okay, language here essentially is when a central bank chairman or president comes to the public and announce a certain policy or certain action that they're going to take. Okay, so the difference over here between language, interest rate, and quantitative easing or monetary policy is language itself is basically just based on words, right? But because it's coming from someone who is pretty important, the market believes this person, what this person say, okay? And that means that, it never really happened yet, but because this person says so, the market takes in that information and already believes that it will happen, right? So for example, if the Federal Reserve chairman says, okay, next month we're going to hike rate. So as of this point in time, the interest rate did not increase yet, right? But because of the language that this person said, the market will assume that yes, interest rate is going to go up and then they're going to take action from there already. Okay, so language would have kind of what we call a first impact in the market before actual things even have actually happened. Okay, so this is something very powerful as well, in which to you as a trader, you want to take note of what the central bank statements are, right? Because that's where the language comes in. It's often more effective if you look at a higher time frame because you have more time to do your analysis properly. And while you take less trade, but your profit potential is definitely bigger, right? So that's the difference between scalping and not scalping it. Right. Okay, Maruti asks, please explain one more time about the hawkish and dovish. Okay, let me draw in so that you can visualize what I meant. Okay, now let's just say you have this scale, right, and then on one side is dovish, or what we mean by bearish, and then the other side here you have hawkish or bullish, right? So the idea here is you first identify, right? Like for example, the Fed. Okay, where you position the Fed right now? Okay, I would say somewhere around here, right? Hawkish. Okay, why? Because they're hiking rates. Okay, inflation in the US is not really low. It's still there. It's still quite high, right? And the Fed is still looking at more rate hikes, right? So it's definitely there. Okay, so the idea of this is you look at the news that's coming in. Okay, which is the core PCE price index, which is important, right? Because this is inflation rate. So what you do is when Friday's data comes in, okay, if it's low, okay, so which means if PCE price index is negative, what it means is that inflation is pulling back, right? It's not as high anymore. So what happens is that this would then push the Fed position maybe a little bit lower here in this scale, right? So it's from like super hawkish to maybe hawkish, okay? Or you can see as hawkish to less hawkish, okay? Can understand that, right? So that then would have an impact in the dollar, right? Because if you take a look at that from this angle, okay, hawkish Fed bullish dollar, right? So if less hawkish Fed, less bullish dollar. You follow me? And of course, if the data comes in super, super hot, which means that PCE price index is very high, inflation is still there, then of course the Fed will be more hawkish, then the dollar will be more bullish. So, this can help you visualize and understand that a little bit better, I hope. Cool. So I hope today you enjoy this session. You kind of get some insights to help you in your trading as well. For those of you who are actively trading already, right? All the best. Okay. Hopefully we are able to catch some of those opportunities that I share with you as well, right? Especially on the dollar CAD, dollar yen, okay, pound yen, and Aussie CAD over here, right? Hopefully that will work out, right? And if you're monitoring on that, you have a strategy to capitalize on that. Hopefully you can catch some profits from there as well. Good. So that's all from me. See you guys next week. Okay. And all the best to your trading. Remember to manage your risk. Yeah. So with that, we'll end off the session over here, and good night. Bye-bye.